The S&P 500 is trading at fair market value, if actually not a little bit undervalued. I'll prove it right now. And I do the scare quotes because you can't prove anything. But check this. Here's my man Brian Westbury over at First Trust Advisors. And I've said Brian Westbury's names 1,000 times if I said it once on this channel. But big fan, long time, first time. Anyway, they're consistently been bullish on stocks since 2009. The bullishness has paid off, although not every year. Stocks fell in 2015 and 2018, but since 2009, the market has rebounded from every correction. Why have we stayed bullish? Because our capitalized profits model. All right. In the past 12 years, we set a forecast for the end of each year. When the market's corrected, we often just reiterated the call for the next year. But a few of these years, we ended up raising our forecast during the mid-year. For 2021, we set out our year-end target at 4,200 for the S&P 500. By mid-April, the market was already flirting with 4,200, so we raised it to 4,500. Now, once again, the stock market has outpaced our bullishness, surpassing 4,500, so we're raising it to 5,000. Crazy. Now, check this out. We also got economy-wide corporate profits for Q2 that were an astounding 9.2% up from Q1 and up from 15.8, which is the pre-COVID peak in late 2019. All right, so that's interesting right there. So remember that. 15.8 from pre-COVID peak of 2019. All right, so pre-COVID peak would be roughly, would we say, because COVID really started hitting in October, but we didn't really know about it until February. That's 2020. But still, that's of interest to me right there. That's why I disagree with Brian a little bit. These figures led us to update the capitalized profit model. As many of you know, we think the current 10-year yield being at 1.3% is being held artificially low by the Feds. I agree with that. As a result, we discount current profits using a far more cautious rate of 2% on the 10-year Treasury. Plugging that rate into the model with superb Q2 profits generates a fair value estimate of 61.33. That's even too high for my man Brian. So if corporate profits fell by 36% and the 10-year was at 2%, the market would be at fair value today. All right, so keep that in mind. If the profits fell by 36% and the 10-year was at 2%, the market would be at fair market value today. The same result would occur if the 10-year more than doubled to 2.7. In other words, the market is rising for a reason. Profits are up and the threat from higher interest rates remains low. Thus, we think it's prudent to raise our 2021 forecast till 5,000 by the end of 2021 on the S&P 500. Hang tight. He doesn't think the U.S. is going to lock down again. I agree. They're aware of tax rates could go up. I agree with that. They're already priced on that in there. This is what he thinks has already been baked in. However, all right, so check this out. Remember, the Q2 profits are up 9.2% from Q1. All right, just remember that. Up 15.8% from the pre-COVID peak in the late 2019. All right, so let's take our trusty calculator. We're in September. So we got 15.8% over the course of, what's that, about 18 months or so? Yeah, 18 months. So we're going to take 15.8, we're going to divide by 18, because that'd be the start of last year. So corporate profits are up by about 0.87% a month, if that makes sense. 0.87% a month going back to 2000 and basically the beginning of 2020. What does that mean? So check this out. I have it at 0.87% a month. We times that by 12. That means corporate profits are growing about 10.5% since the high mark of the latter part of 2019. I'd actually say it's about 9%. Simply because we're going back to, I think, November. We'd have to add a couple more months, but we'll just use 10 as a nice round number for corporate profits since the beginning of this insanity. All right. Corporate profits are up by 10% a year on an annualized basis, going back to the beginning of the end of the normal era. All right, corporate profits are up by 10. I think we can kind of all agree with that. Brian uses a 36% decline, just giving an example. So we take 10 minus 36%, and that gives us at a corporate profit earnings of 6.4%. 6.4 is corporate profits. Now, I want to show you guys something else too. The reason I'm laughing is because here's personal income rose in July by 1.1%. All right, so I hope you see where I'm going with this. I just want to show you again. Corporate profits are up 9.1% in from Q2 to Q1. How much were they up from Q1 to Q4? More than that, because you can see. But here's real personal consumption expenditures in red. That's not net of inflation. This is real personal consumption expenditures in blue, net of inflation. So you can see, going back to 2013, goes up, goes down, flats, goes down again, drops way down, then it goes up, goes way up, and you see where the trajectory is going here? So the trajectory is not on a free fall anymore, but certainly a decline. And if you it doesn't take a rocket science to sit there and say the corporate profits are beginning to go back. It's a decelerating increase, if that makes sense. So if it's 9.2% in Q2, I don't know what it is in Q1. I don't know. Frankly, it doesn't matter. It's dropping like a freaking brick in water. But if it's 9.2% quarter over quarter, and only 15% since the whole year. I mean, remember, corporate profits since they started this right here, we're only up 15%. Now, this is consumer expenditures. It's going to go hand in hand. Because remember, what drives growth in the economy? Consumer expenditures. So basically, we can kind of extrapolate corporate profits and put it here. It's going to be the same thing. We have a decelerating increase in corporate profits and a decelerating increase in consumer expenditures. Interesting. What do you think is going to keep happening? It's going to decelerate, continue. So if we have a 36% decline in the corporate profits, that'll give us about 6.5 year over year corporate profits. Add the dividend of the S&P 500. Let's check it. We have a 1.24% dividend yield right now in the S&P 500. 1.2. So we take 1.2 plus that by 6.4, the corporate profits year over year that I would expect, because I do expect a decline, significant, maybe not 36%, maybe more. A decelerating trend, though, would indicate that we are going into more of the normalcy. So we take 6.4, the corporate profits increase, plus 1.24, and we have a increase in the S&P 500 of 7.64. Subtract a 2% rate of inflation, and we have a 5.64% increase in S&P 500. That's what I would expect, 5.64 annualized. So I don't know if it's going to be 5,000 by the end of the year. I don't know, frankly, I don't care. But to say that the stock market is we had a guy yesterday posting on my live stream, like he said, what did he say? Should I sell my house, or should I invest in a house, or invest in the market that's about to crash? Like, this is a stupid question, because you obviously told yourself the market's about to crash. Why would you? I don't get it. But anyway, we have a profit. As long as corporate profits continue to grow and there's a dividend that continues to be paid, there should be a continued growth in the market. Now, it doesn't happen perfectly. We saw in 2019, the markets were 2018, the markets were down, even though corporate profits were through the roof. 2019, the markets were way up, even though corporate profits were falling off a cliff. 2020 was such a nutcase. But anyway, so it's not this year. We have a 6% profit margin increase. Thus, the market will grow by 6%. You can't find any better number than corporate profit growth year over year plus dividend yield to give you your forecast. So 5.6% net of inflation for the S&P 500. Now, in Right Capital, I'm using a 6.5% net of inflation, 6.5% before inflation, FYI. So net of inflation, I'm only getting 4.5 in Right Capital, because I always want to err on the side of caution. But the S&P 500 is certainly not overvalued, not like bubblish. Just because it's at this record peak doesn't mean crap, man. You always got to look at the competing assets to deploy your money in. Competing assets are real estate. No one's going to sit there and say that's low. Competing assets are bonds. If you say that's low, then get out of here, because that's just nuts. The competing assets, Bitcoin, I don't know. But no one's going to sit there and say the S&P or the other assets are very attractive relative to the S&P 500, unless you're just not dealing in reality. And that's what the bubble did. I mean, that's literally what Bernanke, Ben, and all the other guys, Powell, and whoever the hell else was yelling. That's what they wanted, inflation of the asset base. They've inflated it. It's not a bubble, though, man. It's not, because corporate profits are marching in line with the rising prices. It's not rocket science. It's not. Now, I want to be clear. Just because we have a corporate profit does not mean that we won't have a bear market, a market decline, a correction, even a crash. Doesn't mean we won't. It just means because we don't know what's coming. But as we sit here today, There's no evidence that we're going to have a big bear market. Now, something could come around the pike, the Lambda variant. I don't know. I literally have no idea. But just because it's corporate, the prices are higher than ever, the profits justify it. If the profits don't justify it, the market will come down. Right now, the profits justify it. So as we say here today, the S&P 500 is fairly valued, or it's a little bit undervalued. Because again, I'm already given a 36% decline in earnings, just because that's what Westbury is using. If we get a 36% decline in earnings, not only is that a deceleration, that's a negative earnings, which would be a bear market for sure. But I'm already given a 36% decline off of the 9.6. So that, no, I state that back, it won't be a bear market because that's, again, a decelerating curve on the earnings. The growth is slowing down. Instead of being 9.2, it'll be whatever I said, 6.4. If we get a couple more quarters of back-to-back, then you would see a bear market. But no one's thinking that. Just as we sit here today, no reason to think there is a bear market imminent. All right, we'd love to hear your thoughts. We'll see you.